The hook and promise. How many funds do you actually need to invest for life? It's a question that sounds simple, but the answer can feel surprisingly complicated. Investors often get overwhelmed by choices, thousands of ETFs, mutual funds, stocks, bonds, and wonder if they have to juggle a dozen different investments to build a solid portfolio. Today on the Capital Breakdown, we're cutting through the noise to explore how a simple three-fund portfolio can cover the essentials of investing. By the end of this episode, you'll understand why simplicity and diversification go hand in hand, how to think about different asset classes as building blocks, and what happens behind the scenes when you invest in these funds. No jargon, no fluff, just straightforward principles to help you build a clear foundation for your money's growth journey. The problem or confusion. Many people believe that investing means choosing dozens of stocks or constantly switching funds to beat the market. It's like trying to build a complex recipe without following a clear plan, adding random ingredients in hopes something sticks. For example, someone might feel pressure to own the latest tech stock, a trendy clean energy fund, or a hot cryptocurrency, thinking more variety equals better results. But this can lead to overcomplicating your portfolio, higher costs, and increased stress. Just like when you manage your monthly budget, spreading your money too thin or chasing shiny new things often leaves you with less control and clarity. The truth is, investing doesn't have to be a puzzle with endless pieces. It can be a simple structure that covers broad market exposure and balances risk. Core concept explained. Imagine your investment portfolio as a three-compartment basket. Each compartment holds a different type of asset: stocks, bonds, and sometimes a third piece like international stocks or real estate funds. Stocks represent ownership in companies. They tend to grow your money over time, but can be bumpy along the way. Bonds are like loans to governments or companies. They usually offer more stability and steady income, acting as a cushion when stocks wobble. The key idea is diversification. By spreading your money across these compartments, you reduce the risk of putting all your eggs in one basket. A three-fund portfolio simply means you pick one broad stock fund, one bond fund, and one other diversified fund, covering the major areas of the market without overcomplicating things. This approach aims to balance growth potential and risk in a straightforward way. Core concept explained. Continued. Think of it like a balanced diet for your money. You wouldn't eat only one type of food to stay healthy, right? You want fruits, veggies, grains. Each plays a role. Similarly, each fund in your portfolio contributes something unique. The broad stock fund captures the overall market's growth. The bond fund adds stability. And the third fund, often international stocks or a real estate fund, introduces extra diversification by including markets or assets that don't always move in sync with U.S. stocks and bonds. This mix smooths out the ride over time. It's not about chasing the highest returns in the short term, but building a resilient portfolio that supports your financial goals over many years. That's the heart of the three-fund portfolio strategy. How it actually works, behind the scenes, these funds are managed by investment companies that pool money from thousands of investors like you. They then buy a collection of assets, stocks, bonds, or both, according to the fund's objective. For example, a broad stock fund may track an index representing the largest companies in the country, aiming to mirror its performance. When you invest, your money flows through a broker or platform that facilitates buying shares of these funds. Regulators oversee this process to protect investors and ensure transparency. These funds charge a fee, called an expense ratio, to cover management and operational costs. While generally low for index funds, fees can add up over time and affect your returns, so keeping costs down is a smart move. This system allows individual investors to access a diversified portfolio without buying hundreds of individual stocks or bonds themselves. How it actually works. Continued. It's also important to understand that these funds trade during market hours, and their prices fluctuate based on the underlying assets' values. When you add money regularly, like monthly contributions, you're buying more shares when prices are lower and fewer when prices rise. a concept known as dollar cost averaging. This helps smooth out the impact of market ups and downs. But remember, investing isn't a guaranteed path to profit. Market downturns happen, and prices can fall, sometimes sharply. That's why having a diversified portfolio through these three funds can help reduce the impact of any single sector or asset class performing poorly. It's a balance between risk and reward, managed over time through consistent investing and patience. Simple, concrete examples. Let's picture two investors. First, Jamie, who decides to invest a fixed amount every month into a broad stock fund, a bond fund, and an international stock fund. The classic three-fund approach. Jamie's contributions buy shares consistently, taking advantage of market fluctuations by purchasing more shares when prices dip and fewer when prices rise. Over time, Jamie benefits from the growth of different markets while spreading risk across asset types. Meanwhile, Alex chooses to invest in a single speculative stock, maybe a new tech startup, hoping for high returns. This can feel exciting but comes with significant risk. If that company faces challenges, Alex's portfolio could take a big hit. Emotionally, Jamie likely experiences less stress because of the diversified approach, while Alex might ride a roller coaster of emotions tied to one company's fortunes. Simple, concrete examples. Continued. This contrast highlights why many investors prefer the three-fund method. It provides a solid foundation that's easier to manage and less susceptible to wild swings. Jamie doesn't have to worry about timing the market or picking winners because the funds collectively represent a broad slice of the economy. Alex's approach, while potentially rewarding, requires careful research and a high tolerance for risk, and even then, results are uncertain. Neither approach guarantees success, but understanding the mechanics and emotional impacts helps you make decisions aligned with your comfort level and long-term goals. This is what we strive to clarify here on the Capital Breakdown, empowering you to build strategies that fit your life, not just chase trends. Risks, traps, and common mistakes. A common mistake is thinking diversification means owning a lot of different funds or stocks without understanding overlap. For example, buying multiple tech-heavy funds can concentrate risk instead of spreading it. Another pitfall is chasing short-term performance, buying what's hot today and selling when it cools off, which often leads to losses. Volatility, especially in stocks, can be nerve-wracking, but it's normal in investing. Using leverage or margin to amplify returns is another trap. It magnifies losses too and can be dangerous for most investors. Time horizon matters hugely. If you need money soon, a stock-heavy portfolio can be risky. Patience and sticking to your plan through market ups and downs usually serve investors better than frequent trading. Understanding these risks helps you avoid surprises and stay on track. Risks, traps, and common mistakes continued. Also, beware of fees and expenses sneaking into your portfolio. High-cost funds or frequent trading can erode your gains over time. The three-fund portfolio often uses low-cost index funds or ETFs, which helps keep these costs down. Finally, don't underestimate the emotional side of investing. Market dips can trigger fear, pushing people to sell low and buy high. Building a simple portfolio with clear reasons behind each fund can give you confidence to hold steady. Remember, investing is a marathon, not a sprint, and managing risk through diversification and time helps smooth the journey. How to think about this tool. The three-fund portfolio is a versatile tool, but not an isolated solution. It works best when integrated into your broader financial life. That means having a budget to cover day-to-day expenses, an emergency fund for unexpected costs, and clear goals like retirement, buying a home, or education savings. Your time horizon and risk tolerance influence how you might adjust the balance between stocks and bonds within the three funds. It's also important to review your portfolio periodically, not to chase returns, but to make sure it still fits your evolving needs. This approach encourages disciplined investing and avoids emotional decisions. Think of your portfolio as one piece of your financial puzzle, a reliable, balanced foundation supporting your long-term ambitions. How to think about this tool. Continued. By simplifying your portfolio to 3 broad funds, you free up mental energy to focus on bigger picture financial habits, saving consistently, controlling spending, and planning for life's milestones. It's about building confidence in your money decisions and reducing overwhelm. This method doesn't require you to be a market expert or spend hours researching individual stocks. Instead, it leverages the power of the overall market and diversification to help you grow wealth steadily over time. At the Capital Breakdown, we believe that simplicity and knowledge together create momentum for your financial future. Recap and educational disclaimer. To wrap up, remember these key ideas. First, you don't need dozens of funds to build a strong portfolio. A simple 3-fund mix covering broad stocks, bonds, and international markets can provide effective diversification. Second, understanding the role of each fund and the risks involved helps you stay patient and avoid common pitfalls like overtrading or chasing trends. And finally, integrating this approach into your bigger financial plan, budgeting, emergency funds, and clear goals creates a roadmap that supports your long-term success. This episode is purely educational and not personalized financial advice. Always do your own research and consider consulting a qualified professional before making investment decisions. Thanks for joining me on the Capital Breakdown, where we break down money, markets, and investing in ways that make sense. Until next time, keep learning and keep building your financial foundation. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.